If you are a homeowner in need of cash, you have the option to take out a home equity loan or home equity line of credit. Tell me more, Rob.
Well, the question is, everybody needs to know, is it a good idea? The answer is, the thing you don't ever want to hear, it depends. Okay. ABC's Allison Cossack breaks down the advantages and the risks, and there are a lot of them.
Home prices have been trending upwards, which means home equity is too.
So home equity is essentially how much of your house you own. So if your house is worth $500,000 and you've got a $400,000 mortgage on the house, you've got $100,000 in home equity.
Bankrate analyst Jeff Ostrowski says homeowners can tap into this money by taking out a home equity loan.
That's sort of like a second mortgage. It has a fixed rate and typically like a 15-year payoff period.
Or a home equity line of credit, which is more like a credit card with a variable interest rate.
The lender will approve you for a certain amount, like say $50,000 or $100,000, but you don't have to spend all that money at once. And then at a certain point, you can't take out any more money and you start repaying that loan.
Ostrowski says that although interest rates on these options tend to be higher than mortgage rates, the upside is that it's much cheaper than credit card debt. So should you tap into your home equity? Ostrowski says it depends on what you will spend the money on. He says go for it if the money is for renovations like a new kitchen.
The rationale is that replacing a kitchen is a long-term investment. It's something that's going to add value to your home. It's going to help you enjoy your home, and it's something that you should be able to use for 10 to 15 years.
But he advises against it if the money is to finance your lifestyle like vacations, shopping sprees, or electronics.
That cruise is going to be done in a week, but you'll be paying for it for 15 years.
Ostrowski says using the money to consolidate debt can be a good idea, but only if you can stick to a budget.
You're paying a lot of credit card debt. You're paying 25% on your credit cards. Yes, you want to get rid of that, but you don't want to tap your home equity to pay off your credit card balances and then just turn around and run up huge credit card balances and in 6 months or a year be in the same situation.
Ostrowski says to be careful, borrowing against home equity is a lien against your house. So if you default, you could face foreclosure. Allison Cossack, ABC News, New York.